Hey, what's up guys? Welcome back to DG Capital. Today, we'll be taking a look at the Smith Maneuver. This is a legal strategy that effectively makes interest on mortgages for residential properties tax deductible. So, let's get started. As a financial planning strategy, the Smith Maneuver allows you to convert the interest you would pay as a homeowner on your mortgage into tax-deductible interest. For the Smith Maneuver, you as a borrower need to obtain a re-advanceable mortgage, which is slightly different than a traditional mortgage. This strategy is named after a financial planner, Fraser Smith, who popularized it back in 2002. In the United States, many homeowners can deduct mortgage interest on their 1040 Schedule A when filing their taxes. However, in Canada, interest paid on mortgage loans for your personal residence is not tax deductible. Considering today's real estate market and the sizable mortgage loans that people have to carry in order to purchase a home, taking advantage of the Smith Maneuver will allow you to take that tax deduction in order to ease the burden of those mortgage payments. Not only can you make interest tax deductible by using the Smith Maneuver, you can also increase your tax refund, reduce the number of years on your mortgage, and increase your net worth all at the same time by incorporating the strategy. The Smith Maneuver is not an overly complicated strategy. However, you need to consider your risk tolerance, financial discipline, investing horizon, and the state of the general economy to see if this is a strategy you are comfortable taking on. So how does the Smith Maneuver work? To understand how the Smith Maneuver works, first we need to take a look at what a regular mortgage looks like. When you get a regular mortgage, you have to make a down payment towards the purchase price of your home. The minimum down payment will vary based on the price of the home you're buying, but in most cases will be between 5 and 20% of the home purchase price. As you continue paying down your mortgage, you build equity, and generally speaking, when that equity exceeds 20% of the value of your home, you can take out a home equity line of credit, or HELOC for short. In general, you can borrow up to 65% of the value of your home through a HELOC. Combined with your mortgage balance, the maximum debt should be no more than 80% of the value of your home. This is called the loan to value ratio, or LTV. This is the max amount in percentage your financial institution will allow you to borrow compared to the value of your home. Most financial institutions will lend up to 80% of your home's value, minus what you already owe on your mortgage, but some may lend less. Your HELOC can then be used to pretty much pay for anything, such as a new car, a vacation, renovations on your existing property, maybe a down payment on a second property, or for investing. The traditional HELOC works just like your typical line of credit. You are approved to borrow up to a certain limit, and if you want to increase that credit limit, you have to talk to your financial institution. Now that we covered what a traditional mortgage looks like, let's look at what a re-advanceable mortgage and HELOC combination looks like. For the Smith Maneuver, you will need to obtain a re-advanceable mortgage. This is slightly different than a traditional mortgage, as the re-advanceable mortgage consists of two parts. One part mortgage loan, and the second part HELOC. In this case, the HELOC limit increases as you pay down your mortgage and gives you room to directly access your home equity. When you take out an investment loan, the money you borrowed must be used for the purpose of earning income from a business or property. Property income includes interest income, dividends, rents, and royalties. The interest you pay on this loan is considered a tax-deductible expense and will reduce your capital gains, income, and profit during tax time. When you buy a home that you plan to live in and take out a mortgage, you are required to make periodic mortgage payments. This mortgage payment has two parts: mortgage interest and principal. In this scenario, in Canada, the interest portion of your mortgage payment is not tax deductible. The reason is that you are using this property to personally live in versus renting it out. If you were renting out the property, then this interest would be tax deductible. What the Smith Maneuver does is that it converts your mortgage loan into a type of investment loan. And as we just learned, interest on an investment loan is tax deductible. Let's look at the steps you need to take in order to complete the Smith Maneuver. Step number 1, obtain a re-advanceable mortgage loan from a lender. This type of mortgage consists of a regular mortgage and a re-advanceable HELOC, which increases by the same amount of the principal you pay down on your mortgage. This means that the more principal you put towards a mortgage, the more funds you can access through your HELOC. Step number 2, use the funds from HELOC to invest in income-producing assets. You can invest in dividend stocks, growth stocks, ETFs, mutual funds, or rental property. Step number 3, deduct the interest paid on your HELOC when filing your taxes. This should result in a tax refund that is based on your marginal tax rate. For example, if your marginal tax rate is 38% and the interest you paid on your HELOC is $10,000, multiply that $10,000 by 38%, that will give you an extra $3,800 in tax refund just for deducting that interest on your HELOC on your taxes. Step number 4, using the tax refund from the interest deduction along with the income generated by your portfolio of investments, whether it's dividends or rent, you can pay down your mortgage. This automatically increases your available HELOC limit and provides funds available to buy more investments. Last step, step number 5. Now really pay attention to this one. Repeat steps 2 and 4 until you pay off your mortgage. This is a potential great situation. As you acquire more income-producing assets, they provide additional income, which then you use to pay down your mortgage. Another tip, eligible dividends are also taxed more favorably than rental income or interest income. Let's take a look at an example involving the Smith Maneuver. Let's say you own a home worth $500,000 and you have a mortgage of $300,000. Your monthly mortgage is $2,350, of which $1,000 is interest and the remaining $1,350 goes towards the principal. Through a re-advanceable mortgage, you have access to a HELOC limit of $100,000. Why only $100,000? Well, take the $500,000, which is the value of your home, multiply that by 80%, which gives us $400,000. Now you subtract the mortgage loan outstanding of $300,000, which gives you a HELOC limit of $100,000. Now this $100,000 can be used for investing. Take note that in this example, I used a loan to value ratio of 80%. That's how I went from $500,000 to $400,000. In addition to the $100,000 of HELOC that you can access, your monthly HELOC limit also goes up by $1,350 because of your monthly mortgage payment. This $1,350 is the principal portion of your monthly mortgage payment. Now let's say in any particular year, of the $100,000 you have access to from the HELOC, use $50,000 to invest. And the annual interest rate on your HELOC is 3%. So if you invested $50,000, that would give you an interest expense of $1,500 that you can then deduct on your taxes. Let's look at the risks versus rewards for the Smith Maneuver. The Smith Maneuver is a risky investment strategy. It is not risk-free. Essentially, you're trying to leverage your investments using debt. When you use leverage for investing, it can be a double-edged sword because it has the power to amplify your outcomes, both good and the bad. If your investments perform well, you will have increased your net worth as the value of your assets grow. If your plans do not work out so well, either due to poor investment choices, low returns, or down markets, your losses can easily push you into a financial crisis. It's also possible that the interest rate on your HELOC is higher than the return you get from your assets. Another consequence of this strategy is that your net debt remains the same rather than being paid down, as would be the case with a conventional mortgage. For the Smith Maneuver, as you pay down your mortgage, your HELOC balance goes up, transferring one debt to another. Depending on your risk tolerance, financial discipline, investment horizon, and the state of the economy, the Smith Maneuver may not be appropriate for you. To increase the chances of the Smith Maneuver working out for you, you are better off having more time on your side. Some of the strategy's main proponents advise that you be prepared to invest for the long term, maybe even 20 years or more. A long-term approach means you have time on your side, so that way you can wait out a market downturn. Let's look at some other considerations for the Smith Maneuver. Your maximum HELOC plus mortgage cannot exceed 80% of the value of your home. You don't have to use all the funds from your HELOC for investing, only what you're comfortable with. You will need to keep track of all your investments, dividends, interest payments, everything related to the HELOC in the event of a CRA audit. Registered accounts like the TFSA or the RSP do not allow for interest deductions on loans. So for the Smith Maneuver, your investment holdings must be in a non-registered account. If you choose to invest in growth assets versus income-producing assets from the funds available from your HELOC, this will allow for more capital appreciation, resulting in future capital gains. By deferring your capital gains into the future, you can benefit from even more favorable taxes on capital gains compared to dividends or interest income. The Smith Maneuver does not change the principal residence exemption status of your home. If you sell your home later, you will not be subject to capital gains tax as a result of using this strategy. After paying off your mortgage using the Smith Maneuver, you should now ideally own a very sizable investment account and can either sell off some of your investments to pay off your HELOC, or keep the investments and just keep paying off the interest due on your HELOC. Interest amounts paid on your HELOC will still be tax deductible. The Smith Maneuver is not for risk-averse investors. Leverage will amplify your gains, but also worsen your losses. Consider seeking financial advice from a professional if you are considering executing the strategy. And that's it for today's video. Please hit that like and subscribe button. Leave your thoughts in the comments and share this video to help support the channel. And I'll talk to you guys next one.